let's get into some fun stuff here. I know that I got some stuff on the mortgage side.
Let's start there.
Yeah,
I
let's
mean, because
let's start there.
one thing I'd like to do is make sure that we do kind of step back and look at the arc of this, like where we started, how we got here, what this means for the broader economy. But let's start. You're the expert in the room when it comes to a specific area, so let's start there.
All right, so what I want to start with is basically how mortgage origination occurs, how loans are purchased, and the flow of that. And what
Okay.
I'm going to do is, and if I can do this, this is going to be awesome. Last time I tried this, it didn't go so well. So, but let's keep adapting and figuring it out. All right. So on our Facebook Live, hopefully it's coming up, but you
Yep.
can see down at the bottom here. So there's basically three different channels that originate loans, and that's how the loan in the mortgage industry starts, right? So it's going to be through a broker channel, a correspondent channel, or a retail channel. Your broker and correspondent, they pretty much sell up the line, right?
So talk to me like I am
Okay.
if you would, like I'm someone purchasing like I'm buying a house.
Okay. So you're buying a house. When you go and talk to that loan officer, right, you're not going to know really where that end loan is going to. The only thing you can see, let me see. Let me step back. So your servicer is one way to make money, but then the person holding the actual note or whatever
Mhm.
is another. So
Okay.
it's let me start back here. So you got a broker channel, correspondent, and retail. Your broker channel, the end investor is going to fund at the table. So if it's a Quicken, a Caliber, Loan Depot, PennyMac, UWM, they actually fund at the table with their money. So that's how the broker channel works, right?
Uh-huh.
The correspondent channel, they fund with their own money, but they utilize the warehouse line of credit. So they got a couple million, they flow, they put stuff on the books, and then they sell it back off, right? So
Right.
broker channel and correspondent channel are pretty similar. The only difference is basically the broker doesn't fund with their own money. The correspondent utilizes the warehouse line of credit and then funds it. Retail, like your Fifth Thirds, your actual retail division of the bank, they're limited to just that, the depository access at Fifth Third, right?
Okay.
So what people and most people don't understand is that Fifth Third, PNC, Huntington, they have what's called the wholesale side. So the wholesale side is where your brokers and your correspondents, that's where they deal with. So they have raw pricing, and then they offer that to the brokers and correspondents, right? And it just
Right.
gets sold up the line. So I'm hoping that it's sharing this screen, but
It is.
okay. So you've got what are called non-banks, and then you have what are called banks. The non-banks are banks or lenders that do not have depositories backing them. They don't have FDIC insured. They don't have depositories, right?
Right.
So
Not a
they
traditional bank.
not a traditional bank. They just have warehouse lines of credit that they utilize as well. So where this forbearance issue is going to be a huge problem, and I cannot stress enough, honestly, on what this is going to do. So first off, forbearance is not a forgiveness. It's not forgiveness. Like it's not, hey, don't make your payments for 90 days and we'll just forget about it. Forbearance is it's just there is no financial benefit to utilize the forbearance program. You're either going to put it on the back of the loan if the servicer agrees to it, or you're going to call and it's going to be due on that fourth month. So you may skip, month 1, month 2, month 3, month 4, all 4 of those payments are due. If not, it's done. Like
Sure.
you're getting foreclosed on. Like, I'm sorry, but the the courts will open back up and they will start foreclosure proceedings. So where I'm going with this is that your servicers are who accepts all your payments. They divvy out your principal, interest, tax, insurance every month. So that's who you make your payments to. So those servicers, like on the right side, you got Quicken, Caliber, Loan Depot, all the way down. They can be servicers, right? So like,
Right.
it could have came from a broker channel, correspondent channel, or a retail channel. But
Right.
these are who your main servicers are. Half of them, the banks, have access to the depository, and this is where they have a little bit of saving grace, because what's the Fed rate right now?
Yeah, like 0.
0, right? So their overnight lending is not costing them any money.
Right.
These people over here on the left, the non-banks or your non-traditional, they do not have access to that, and they are running into what's called a liquidity. It's a liquidity issue. They're running out of funds.
This is you're talking about the $2 trillion stimulus package.
Correct.
What it did not include was capital available to non-banks.
So it actually, and one of the things that they did was they actually pumped money into mortgage-backed securities, which actually sped up the refi rate, which then
Sped up, meaning you mean raise?
Capital. What's that?
Okay. You mean raise? When you say sped up the refi, what does that mean?
Yeah, so everyone, so when you pump money, let's go back into, you've got your GSEs. So your Fannie, Freddie, so those are your conforming loans, right?
Right.
And you got your Ginnie Mae, which is your Govy loans. All of these, once the loan goes through, they get sold to Fannie, Freddie, Ginnie, and then it goes to like basically an investment banker that packages it up into what's called a mortgage-backed security. The mortgage-backed security then is sold on the open market, and it's owned by all of our IRAs, 401ks, blah, blah,
Pensions.
blah.
Yep.
So these servicers here, no matter what, every month have to pay that PITI payment for the mortgage-backed securities and also the local taxes and insurance, right? So the servicers still are on the hook for that monthly payment, even though there's a 90-day forbearance right now. So to put it in perspective, these servicers, if a quarter of the Americans out there, if a quarter of the Americans do not make their payment in the next 30 or 90 days, it's an estimated $70 billion cost to these servicers. So extend that on, which they're potentially talking about doing more, 140 billion. Put this in perspective. The total profit of all the servicers out there last year was 10 billion. So just
okay.
Yeah, they're not set up for this. They are not set up for not getting paid and being on the hook. So if you think of a small business, right, they're not bringing anything in now, and they're also on the hook for something way larger than they were ever set up to be.
Right. So basically, what we saw on yesterday was you sent me a message that Caliber, one of the services, has 8,000 forbearance requests.
Wells Fargo was 800,000.
There were 800,000 from Wells Fargo?
Yeah.
Okay, so that starts this clock, right? So they've got, can you explain to me in the stimulus what this loan forgiveness package means? Is it they're good for 90, like you can't get foreclosed on for 90
Correct.
days?
Correct.
And so I get, the way I understood it was you're just basically extending the maturity of your loan by let's say you use this and you stop paying for the next 3 months because you can't.
Mm-hmm.
And then you're able to again. You still owe those 3 months, but just on the back end, right?
Well, so there's three different ways. There's pretty much 3 different ways that it's being, I won't say sold, but put it this way. So the stimulus plan, CARES Act, did one thing. It just enacted like, okay, you cannot have your credit ruined and this and that for those 3 months, right?
Mm-hmm.
Here's what we're going to open up into. So they didn't say out or lay out exactly how the servicers had to react to it. So they didn't say, hey, you got to put it on the back end. Everyone's handling it differently.
Right.
So with that being said, some are putting it on the back end, some, and a lot are calling it due on month 4. So, and to me, that's even scarier because I think the average checking account's like $500. You have the masses basically not paying bills for 3 months. They're not going to come up with 4 months worth of mortgage payments, and that's gonna cause defaults real quick. Some large servicers are basically adding small increase like 10% for, you know what I mean, like for 2 years or so. So there's no guidance on how the servicers have to collect. Essentially,
Right.
I think the best is if putting it on the back end. I get that, but the servicers themselves are not liquid enough to carry that. So you had Wells Fargo come out yesterday, basically said, "Hey, whoa, we're going to run out of money. Like we don't have the money to do this." Therefore, they increased their credit restrictions up to 680. They basically backed off all Govy loans because HUD was the one that initiated a lot of it. So, and they're initiating a lot of the guidance. But basically, Govy loans are severely I mean, no one wants to do them right now.
How does this compare to 2008?
Completely different. So that's the crazy part of all this. Like there's, we had a mortgage crisis in 2008, right? Like that, the thing was like, let me try to.
So is this more like a servicer crisis where banks were backstopped in '08? They're again backstopped here. But the reason they were backstopped in '08 was because that's where the issues were. It was a complete meltdown of liquidity through banks. And so they needed money. We gave them money. The system continued to function and we did fine. Here, well, we can get into the repo market later, but banks on the surface have really not run into a liquidity issue. What you're saying what you're saying is that this package was, the way I looked at it, was very similar to the '08 package, and it's just giving banks money so they don't ever run into a liquidity issue. But the consequence of that was no one thought about what this means for the non-banks. And where you're having the issues when you have unemployment claims like we're seeing is you're going to have an incredible amount of people just not paying. And so there's just not money coming in to banks and to non-banks, right?
Correct. They weren't set up for it. That's not even close to their business model was not set up for handling no payments coming in for that long.
Okay. So what does this mean for, the average person now trying to get a mortgage?
So first off, let's go over, it's forbearance, not forgiveness. So like those payment, there is no financial benefit. So forgiveness would be you don't owe those $6,000 for those payments, right?
Right.
Like that's forgiveness. Forbearance is you're putting it over here and you're gonna owe it eventually. So there's no financial gain to do forbearance. What it's doing
other than personal liquidity.
Personal liquidity, yes. So you may save or may gain $20, but the issue is, are you going to basically cause yourself $100,000 in lost equity because we're collapsing other markets, right?
If we go the route of foreclosure eventually.
If we go the route of, if we continue mass forbearance and there's not an injection of capital into the non-banks, especially the banks themselves are there, they have the ability for the overnight, the Fed stuff, right?
Right.
The non-banks are the ones that I'm super scared of, and they'll go onto the open market. So basically, the news is not telling people what this forbearance is, partly because it was enacted and then it was, we'll figure it out. You know what I mean? So like everyone's just figuring it out now. Let's go over, what does that mean? So first off, we're having loans. I'm not personally yet, but when you go back to how that correspondent setup was, So I fund it on a warehouse line of credit. It's not sold yet, right? So if you don't, if the borrower does not make the first payment, it's a non-sellable loan. It's now a scratch and debt, right? It doesn't fit Ginnie Mae's guidelines.
Right.
Now it's stuck on my warehouse line of credit. I can't sell it, and my warehouse line of credit is not set up for long-term 30-year mortgages. Like, it's just not. So first-time defaults, we're going to start seeing that. And what does that mean? So that means correspondents are tightening up. I mean, correspondents are, hey, we don't know if we can sell it to the servicers, the GSEs or Ginnie Mae fast enough. We're only going to take a paper. And what does that mean? Borrowers that were qualified last month, we're probably cut our borrower pool into conservative half now, just with unemployment and tightening of credit. So that's first payment default is.
So banks are tightening up. Like, so
Absolutely.
So, I was, still am in the process of doing some refis, some cash out refis. And that's when we had a conversation about kind of a status check of those probably aren't going to happen, because for rental properties, they're not taking rental income as part of income. So now it looks like my personal income needs to fit, 7 mortgages.
So
which just isn't, that's not how that works. So the idea of being able to refi is out the window for now.
Well, that's just what that's 2 large investors. So it's coming down. So those are, okay. You're not completely out. Where we could go with basically the banks, the wholesale divisions have raised interest rates, right? The Feds finally stopped buying from the mortgage-backed securities. So it was a good thing. Honestly, it slowed down the rate of refis. And so what we have to understand too is these servicers, the way they make money, they pay 1 point up front and they only make about 30 basis points back a year. So they have to hold it for a little over 3 years to even break even on it. Well, guess what? Anyone that's purchased in the last couple of years, they're eligible for a refi.
Right.
Guess what? When the Feds pumped in close to $38 billion a day, or for a couple of days in a row, and just shot rates down, everyone was jumping on it. So the servicers are losing on the refis, and they're losing on this forbearance stuff. So what does that mean? They're all tightening up.
Okay. So from a broader economic standpoint, though, like, it sounds like the way the stimulus is intended is that there's a timeline where the stimulus will go down as a success if we turn the economy back on within a certain time frame. And that time frame is, call it 60 days, 30, 60 days. I'm just making that up, but there's a hard number there where if we exceed it, we're going to talk about stimulus number 3, stimulus number 4, stimulus 5. And that timeline is not 90 days. And so I think the fear right now is not, I think, as grave as your fears, is that I think most people think that this is going to be, we're going back to normal, relatively soon. I think they're saying the peak in Ohio is in 2 weeks. The peak in some of the other states is the first week or 2 of May. And
you guys
then
are hit pretty hard, right? Or,
no. Oregon is one of the least states.
Really? Okay.
We had the first case. The person actually lived. I lived on the border of Oregon and Washington, and the person lived on. It's kind of like Cincinnati and Northern Kentucky.
Gotcha.
Like, this person would have worked in Northern Kentucky but lived in Cincinnati. And so technically Ohio would have gotten that first case. So Washington was the first case, but he worked in an elementary school 15 minutes from my house. And when that happened, that's when the panic here started. So all the panic happened really fast, and then voluntary shutdowns started happening. schools shut down really fast. And then, but it wasn't until like a week ago or 2 weeks ago that the state did shelter in place.
Yeah.
But our cases are really low. And so we're going to see, I think, not as drastic as obviously New York City or any of those places. Yeah. And Cincinnati's the same. Like we basically, all those graphs you saw where there's a peak right in the beginning and then a tail off, we cut those peaks off by shutting down. What the shutdown is causing, though, is an economic disaster. And I think that the longer we go, we're going to start seeing some of these problems that we saw in 2008, especially in the mortgage market. Just as you said, people have started to, do you know the total number? Like, so Wells Fargo is 800,000.
So that's, I mean, these are just, they're coming out and how many calls they're fielding. It's ridiculous. And honestly, it's because of the news. The news is telling you, and that's the other thing. I mean, I've got wealthy friends that are like, hey, what do I do? How do I do this? And I'm just one person trying to educate them. Like, and it's not their fault. These are really smart people. They just don't, it's being taught as like more of a forgiveness, and it's really not. And the way that I see the potential non-banks, especially and the servicers just getting hit, it's scary. And then what you're coming into as well, and I really want to drive this point home, you're talking about if it ends up being like a loan mod or loan modification or some of the programs, you have to just basically, you have to have 12 months paid history, right? Mm-hmm. You don't have those three, so you might be disqualifying yourself for future mortgages. And these are, and that's a big deal. So now you've got unemployment. You just sent me that one thing. I mean, the projection on the unemployment's.
Well, yeah. So that the unemployment number is tough because it includes furloughs. And again, it comes back to that expectation of the future where companies are furloughing their employees, which means they stay registered as employees. They keep their health care. They just don't get paid. And what the stimulus package did is it came in and boosted unemployment benefits for those people. And a lot of them are furloughed for a month. Some now they're extending those furloughs for 2 months. And some furloughs are turning into layoffs. And where layoffs are scary is those jobs are gone. And to get them back takes an extraordinary amount of time and resources to hire, to interview, to do all that stuff. And the company needs to assess whether or not the need is there for that job. And so I'm scared about, 10 million people lost their job in the last 2 weeks. Mm-hmm. That is 6% of the workforce does not have a job. And those numbers are lagging. You know, there's going to be way more than that in the future. And the latest expectation from the Fed is that with 10 million, with those 10 million that have lost their job, we've gone from a 3% unemployment rate to now effectively a 10% unemployment rate right now. In the financial crisis of 2008, the highest we ever got was 10%. The Great Depression, the highest we ever got was 24.9, call it 25% unemployment. The Fed's latest projection is that before this is done, we will have 32% unemployment. Now, the overwhelming majority of those are furloughs. And the hope is that you can turn an economy off and then turn it right back on, which that doesn't make sense to me. There's nothing to suggest that anyone's job in the travel industry is going to automatically be turned back on. Just for that, or the sporting industry. You know, can you imagine the idea of going to a stadium with 50,000 people right now? Like, it's a scary thought. Like, it's just, everyone's going to have pause about social connectivity. You know, we're in social distancing now. It's changing our culture. Yeah. So to me, I'm nervous. So that unemployment number, those big numbers that are coming out, where it's now almost 10 times the number of people being laid off every week, is 10 times the highest monthly total on record.
Well, that's when it was 1.2 was it projected. I knew that was going to be way higher just because I talked to people.
The projection this week was 4 million.
The last week. Last week, though, I think it was like 1.2 and it came out 3.
Yeah, it's 3.5,
Yeah.
and this time was 6. Let's call it 6.5.
Yeah.
So I mean, that's almost 11 million people that no longer are earning a paycheck, and the income they're earning as soon as unemployment benefits start is a percentage of that.
Yeah.
They said that the stimulus was going to basically make them whole, but it only adds $600 a
With
week
600 additional. Yeah.
to whatever. It's an additional. So if you're making 100 grand a year, you're not making 100 grand a year anymore on a weekly basis. So there are a lot of people who are now earning less than they did, and which is why you're seeing all these forbearance requests. And those forbearance requests, if this goes on long enough, will turn into foreclosures. People will just walk away. I'm looking at this as when social distancing guidelines start to ease, that the economy starts to grow, but it's going to be slow. Like, there's no reason to think that you're ever just going to have the same thing you did. Commercial real estate's toast. You know, the idea of going back to an office with 200 people where you're rubbing shoulders all day today is kind of a scary proposition, because you just don't know.
Yeah.
And until the virus is gone, that will always be on the back of minds. So I think we've shifted completely as an economy. We've shifted as a culture, and it's impossible to know what that shift is going to do to us. But one thing is for sure, it's going to be different, and it's going to be smaller than where we were just a month ago. You know, the economy that we saw, or the culture that we saw in the middle of February is gone, and that's not coming back. What will come back is a something that resembles it, but it will also add on a lot of different things. You know, look at the medical field, telehealth, which was thought of as something that will eventually happen in 10 years when people get used to it. Guess what? Get used to it, because that's where we're at now. It was forced on you. And so the repercussions of that going forward, I think for major doctor practices is going to be rough. Because people are going to start realizing, like, wait, I don't have to go to the doctor. I can just call them and do a video conference like this. Like, it's forcing all these adaptations. So there's going to be industries that do well because of this. There's also going to be industries that suffer. But when you have 10 million people lose their jobs in 2 weeks, the shock that has emotionally is rough. And to expect that to just all go away and turn back on, I think is naive. I think it's based on hope, which is fine, but hope's not a strategy. And so one thing that I'm telling all of my clients, I tell the public, is this is a lot worse than what you're seeing. You know, the choices we made as a society was, you've got healthcare is one thing and you've got the economy as the other, and they're at odds with one another. I'm not saying we made the wrong choice, but the choices we made have severe economic consequences. And there's no data on this either. Like, we've never done this before. We've never turned the economy off and just all collectively decided to stay home. So there's no way to know what this means. But
that's why we can't go back to the Great Depression. We can't go back to 2008. We can't go back to the Spanish flu. Like,
no, it's so different too. We're in a different, I think what it does is it shifts we were on a path, I think, as a society, a more nationalistic path. The pendulum was moving the other way rather than broad connectivity, broad trade. It was going the other way. Brexit's a good example of that. Trump ran on that notion, America first instead of globe first. I think that we see more. I think that accelerates going forward.
So I do too, and that's where I'm optimistic that basically those big changes, they're going to happen, and they're going to happen rapidly. So I think we're going to come back leaner and meaner, and it's just going to be who's going to basically not do well is Susie or Temmie that was in the office that was not bringing value to the office.
Right.
They're cut. I mean, they're cut. The ones that don't adapt, they're gone. I mean,
I also think, though, that over time you're going to see more local manufacturing turn back on. The issue, though, that I think was uncovered in this is, everyone knew everything was made in China, but I don't think people really knew what that really meant. When you have to, what is it? some crazy 90+% of ventilators are produced in China. Like, if they wanted to take over the world, they could right now. And so, but they're not. They're actually exporting those. They're being good trade partners. They're doing just fine. You know, they're not doing what I think a lot of people, the scare tactic people, think they would do. That being said, I don't see us going back to a place where it's business as usual. And so people that are buying the stock market right now, the stock market's still overvalued. It's still, it's
I want to
trading.
know, what do you think? What do you think total correction? I've got my number. What do you think?
Well, that depends on various scenarios. So if you've got, if you see the shelter in place extend through May, and you see more stimulus announced because of it, I think that you will potentially see a Dow of 15,000. I think the 10-year goes negative in that time frame. And what's really terrifying about that is the debt we're taking on as a country is astounding. There actually is historical precedence of making those moves, and it's Japan 30 years ago. They did all of this 30 years ago. It was not in response to a virus, but it was in response to something else. And they increased their debt eightfold. They lowered their rates to negative, and their economy has shrunk for the last 30 years. Their personal incomes have been flat for 30 years. Their economy did nothing. And it was because of the onerous amount of debt they took on. And they just, it's kind of like personal more. Think about if you make $100,000 and you go buy $1 million house, you know, and you have a $5,000 a month mortgage. You will spend you will spend all of your money paying for that mortgage, and you'll have nothing left to grow your wealth. You'll have nothing left to do anything. And that's Japan. They spent so much money trying to stimulate their economy that as interest rates started to rise, they were screwed and couldn't keep up with growth. And that's what we're doing to ourselves right now. So I think that we're not done with the pain. The only way we're done with the pain is that if we see a miracle drug come out, if we can remove the fear of the virus from the equation, I think we've seen bottom. I don't think that's going to happen, especially when peaks are still ahead of us. They were saying now deaths are going to be between 100 and 250,000 deaths in this country. That's really scary. I mean, anyone wants to compare this to the flu, it's bigger than that. And that's with all of the quarantining we've done. Imagine what that number would have been had we not quarantined. So I just look at all these things. The mortgage thing was really scary to me because it's such, it's so reminiscent about 2008. And as a financial advisor, you have various years that you burn into your brain, and those are market correction years. So 2008, 2087, you know, 1929, like all the big ones, you know, all of the 70s, you know, it's just, there are those years that are burned into our brain. And this feels like it's 2008, but now it's also everywhere. So what we saw in the correction was basically, it was a correction that was supposed to happen. In fact, it was happening a year ago.
You were calling it.
At the end of 2018, the market corrected 20% very quickly. Yeah. And then Steve Mnuchin came out and said, no, the Treasury is going to backstop it. We're good. And then we just kept right on going again. The reason it was correcting is it was due. Business is slowing down. The reason business continues to grow is because it's artificial. You know, we were supposed to be in recession if Clinton won. But Trump won. They stimulated the crap out of, we artificially. It's what we're doing. And that's where we are now. I'm not going to, you know, say shoulda, coulda, woulda. It's just where we are now. And so what's crazy is the market's still overvalued even after all this. And the way valuations work is they're always in hindsight on current prices. So the valuation is price over earnings. And so your earnings never changed, but your price has come down. And so your valuations got cheaper. But earnings are going to change, and they're going to be negative. So they're going to be really small. And so when your denominator gets smaller, your total ratio goes way up. So in a month or two, PE ratios are going to go to historic highs. Now, it's not the best indicator of true valuations, but it is a nice barometer of we got a long way to go before we figure out where we're going. And I think in the short term, down is probably more of a likely scenario than up. So yeah, my clients are super conservative right now only because of that. And I'm willing to miss out on a short-term run to protect against another 20-30% loss. So what's your number?
I think overall from our top, I think we're a 50% correction.
So we were at
Overall.
call it 30,000. So that's Dow 15,000.
Yeah.
So yeah, I mean, it's just a round number. It's a total guess, but
And I'm pretty sure I'm going to be right or wrong.
well, I'm 100% sure you will be right or wrong. Correct. Yeah. Well,
So,
what's fascinating to me is that you look at the trends of what people talk about, and they consistently get revised down, not up.
yeah.
And even the future, everyone's talking about this amazing snapback rally we should have because we just printed $6 trillion.
I'm still optimistic. I just don't know how it's going to.
I'm not saying we're done as a country by no means. I just mean that this is a bigger deal economically than I think most people are giving it credit for. Companies like Amazon will do just fine.
Amazon,
Companies like Google,
Zoom.
Facebook, Zoom. I mean, Zoom's got some other issues, some security issues. Might be a good buy today. They got hammered today, but yeah, companies that can adapt really quickly will be fine. The economy will still continue. I think it's just going to be a lot smaller initially, and it's not going to be back even next year. This I think will turn into a pretty big recession. And I think people need to prepare themselves for that.
So I think people should be realistic with it though. Like if you, and that's why I hate the misinformation that's out there. Cause hey guys, it's going to suck for a little bit. Like it really is.
Mm-hmm.
It's not going to get better in the short. We've got some stuff, but if we can make the right moves, I really do think that we're going to come back out of this stronger. And I think
what are some of those moves?
I just think leaning out, I think is going to be the biggest thing. Implementation of technology. I think, like you said, the tele. So the thing is if you're in that commercial space right now, real estate especially, it's going to be tough to fill buildings. I've invested in real estate in the commercial end. I've got one buddy that's always on me to do it, and I've always been against it. I think brick and mortar is kind of going away. It doesn't make sense to me. The Amazon, the drop shipment, stuff like that makes sense to me. Now you're talking about less communication or social interaction. Your Amazon's getting boosted up, right? Mm-hmm. Your schoolrooms, I think my biggest hope is that higher education gets reformed by this, and the school. Basically, my kids at first, we didn't know, what's it going to be like them going to school with Google Classroom? Well, guess what? Now it's easy, and I see them in the kitchen. My daughter's running around with the laptop, talking to Oliver, you know what I mean? Guess what? That technology is not going to go away now. It's been implemented. The struggles, the fears, they've already been settled. Now it's here. Guess what? We can do that at a higher education platform with less debt added on to our system on the back end. So I think schools are going to be reformed, which I'm pretty pumped about.
How's this going to change the mortgage market?
So the mortgage market, it needs money. I mean, I don't even know how to stress the forbearance issue and what it's doing to the servicers. So nothing in life is free, right? So the whole don't pay your, I just can't stress how bad that is. And the biggest thing too is look guys, we're gonna have some equity lost in real estate. I mean, it is what it is. We got 50% less buyers right now. We're in a crunch. We're in a credit crunch. I could say the first payment default is going to be big. Let's see. You've got a lot of VA and FHA buyers, so 0 and 3.5% down into these homes. If I mean, their ability to repurchase is probably going to be gone here in the next couple months, just with loss of equity. So you've got no reentry back into it. So they're back underwater quickly. Let's see. Yeah. The other thing, like with the repayment. So even if you have an 800 credit score, if you did this forbearance stuff and now, or you got a loan mod, the banks aren't going to extend credit to you because that's a show of weakness in the fact that you asked for forbearance. Like,
right.
So like you may have the 800 credit score and it may not be reported negatively, but it's the same thing as the renters right now. The renters, like, we can evict you, like it's going to happen as soon as the courts open back up. And guess what? Then it'll be a lawsuit for all lost. I mean, we're going to get it eventually, right? Like you don't get out of that.
Yeah. I mean, so do you think it changes the dynamic of how mortgages are sold?
I don't know if you go back to, so Fannie and Freddie were just about to come out of conservatorship, right? So they were back
from 2008.
From 2008, and then now it's like maybe that's, I don't know, maybe that's not a good, I don't know. Like, right. Yes, I think the whole landscape of it needs to be redone. I don't know. So here's a good question for you. So generally speaking, people pull out of the regular stocks and go into mortgage-backed securities and stuff like that. Right now, what are you seeing? I guess.
Well, so there's two things working. When you have peak, what I like to call peak panic is behind us. I don't. This is also the case in October of 2008. The market was down. I think it was 25% that month. It was a huge. It was almost like every day the market was down 2 or 3%. Little ups here and there, but it was rough. And so, in peak panic times, everything gets sold and you go to cash. And we saw that in the corporate bond market went down 15 to 17% in 2 weeks. That's never supposed to happen. The only thing to go up was mortgage-backed securities went up a little bit because they're usually fine. I don't follow them as much. I don't actually invest in them a lot because they, from a portfolio management standpoint, you might as well just put your money in cash because they just don't move that much. And when the government's been involved in them for 12 years, they're not going to move all that much. The only thing to go up, I mean, even gold sold off by a lot, 2 weeks ago during what I call peak panic. And so once that happens and you have your first step up, which we saw 2 weeks ago, everyone's calling it the floor. The market actually bounced up 20% from its low. It gave everybody a chance to just take a breath, calm down, and let's start looking around, outside of our walls, because we also were doing this from a place of isolation. And so you couldn't go to the office and talk to your buddies about, dude, what the hell is going on in the market? That was the other crazy thing about all this is everyone's making these really crazy decisions with less information and less good information because they're watching the news or watching pundits yell at them, and so you get a lot of bad information. So I think that's behind us. And what you've seen is that you've seen a resurgence in stability. And most of that is coming in areas where the government got involved, which is a problem. The emerging markets are still seeing malfunctions happening even in their stock markets. And that's just, there's still a heavy amount of trading going on and markets can't keep up with it. And so that's going to be a while. That's why markets are moving 2 or 3% a day. Even though it maybe only closed, except for the last 30 minutes of today, it was going to close up 0.5%. But it moved 4% today, from its high to its low. And that's the reality we're at. And eventually that'll slow down, but it only slows down as economic information comes out. And part of what's different now is the information is different. we're starting to actually appreciate how much economic information lags. You know, you're seeing factory orders shrink a little. Factories aren't even on. Factory orders should be zero, but they shrunk a little last month. Well, yeah, so that just means that those numbers are going to be reflected next month. Once we all have a month or two to just calm down, we'll start to see the economic effect of this, other than just hyperbole, other than just us conjecture. You know, we are in a recession right now. That, like, we immediately started it. We made that decision. How we come out of that is going to be really interesting. So to answer your question, like, all I'm seeing is there's two camps. There's everyone who's really scared and they want to be in cash. And then there's everyone who thinks we all overreacted to this and they want to be heavy levered up in stocks because we're going to come back strong. And so it's really tough to kind of balance those two, because I don't know which one is right. What makes sense to me is it's probably somewhere in the middle. It's not going to be a snapback rally, just because 10 million people are not earning a salary right now. They're actually collecting unemployment checks.
Is that including the SBA, the injection?
No. So the
you know
10 million people are W-2'd employees.
Yeah.
This is not, like, if you're a small business owner, you can't. I mean, good luck collecting unemployment. Like those.
Well, supposedly you can, but I'm saying, like, that. So the Payment Protection Act. So basically, it's unemployment, but paid through the Small Business Association, effectively,
Okay.
to try to keep people off the unemployment. So, like, when you look at that unemployment number, it's not, to my knowledge, it's not. Well, it's not calculating.
It's behind, and it's not the whole picture, and it never has been.
Yeah.
But it gives us a barometer. You know, that's why it's like it's 160 million workers. There's more workers than that in this country.
Yeah.
And so when 10 million of those workers file claims in 2 weeks, I mean, California's saying their website keeps crashing.
Yeah.
They're unemployed. I mean, it's those, you know, those states are lagging more than others. But I'm just, we've never seen a shock to the system like this. And the one thing we're not good at is recovering from shocks quickly. As a society. It's just, we've got to figure out, as one of my favorite analysts that I follow, his name is Mohammed Al-Arian. He used to run PIMCO, and now what he's doing right now is escaping me. But I sent you that quote, and he coined a term in 2008 called the new normal. Like, what is the new normal? And he's saying it again now, is what is the new normal going to be coming out of this? And I don't think it's going to be the old normal. It's going to be a new thing, and that thing is going to be smaller. You know, just back to let's just take college basketball as an example. Like, until COVID-19 is gone, how do you feel about buying a ticket to a college basketball game?
Yeah.
Like, there's pause. There's some people who are like, screw it. It's not a big deal. But I think a lot of us who've been cooped up in our houses for this long a time, even though we desire to go out and give people hugs again, the idea of taking my kids to a stadium full of people gives me pause. And I think in there lies, I think, where our new normal is going to be as a society, is
touching that railing that everyone's touched.
Right. We're going to be a much more sterile environment now, and it's going to be so different. And I think it means that when we turn it back on, it's going to be a fraction of what it was before initially. And over the course of a year or two, we might turn most of it back on. But it's really kind of what's left in the carnage of that turning back on time frame. So you're already seeing it now, where I think Jean Robert closed all of his restaurants.
Yeah.
For good. It wasn't like we're shutting down for 30 days. It's like, nope, not doing that anymore. The restaurant industry is going to be a barren landscape coming out of this. And because restaurant owners, I mean, they're on a razor thin profit margin, and hardly any of them are, just like in most business owners, good at saving money. Yeah. And so they're done. They're just going to walk away. And so the trickle down effect of that is the people who own the buildings. So commercial real estate is going to suffer. Yeah, I just think that type of shock has not hit yet because everyone's expecting, because of the stimulus, that it won't. But
Where do you
regardless,
think the gains will be though? There's got to be there's going to be gains, right? So like, what industries? What are you seeing on there? We know the hospitality is killed right now, right?
yeah. So the
Restaurant.
gains, that's still a hard one. I think that it comes back to gig economy is going to be huge. So like the gig workers are your independent contractors. I think companies are going to start utilizing them more as you get back to your thing of being leaner. I think anything online is going to be okay as long as it doesn't rely on, delivery of products across an ocean. I think those suffer initially, but as long as you can provide something different and meaningful, you'll be okay. It really comes down to a liquidity issue. If you cannot figure out how to get through the next 6 months, regardless of how good your idea is, you're probably not going to make it.
Yeah.
It's just going to take that long. And so, I think to me, the big underlying fear is the virus. And until those numbers look like they're in control, I mean, they're talking about a potential resurgence in the fall. By everyone sheltering in place, it just means that there's all those people that haven't gotten it yet.
Yeah.
And so when we all come out of our house, because there's asymptomatic carriers, we don't know who's gotten it. We don't know who's had it. We don't know any of that. And so there's a real possibility that we could start the cycle again. I mean, Dr. Fauci yesterday said that the worst of it will be behind us in 2 weeks once we reach that peak, but it will be these resurgences, and how many people are going to freak out when that happens again.
Well, and the reinfection, they're talking about the potential of the same people, the reinfection.
Right. So that's somewhat anecdotal right now. It's still new, but yeah,
Sure.
There's that LA Times article of there's Chinese people who are retesting positive after having it and testing negative.
Yeah.
So I don't know how much of that is true, but
sure,
we'll all find that out. So I just think that to make a decision investment-wise to buy stock now broadly is gambling on a lot of hope that this all gets fixed and we all kind of forget about it. And I'm not sure that makes a lot of sense to me. And so I do think that we've got a lot of economic struggles to get through before we get through them. We're not through them. We haven't actually accomplished anything. All the stimulus is doing is buying us time. And it's a giant freaking number, but it's buying us time.
Can we go over that number real quick? How big that actual number is? And I think my personal opinion is that this is number one stimulus, and we're going to have 2, 3, 4.
Well, they're talking now about, so it depends on how it's financed, right? This is weird. So I like to think of it in terms of, I posted this on Facebook, but if you think of it in terms of time, most people have a hard time thinking about what even the difference between $1 million and $1 billion is pretty big. People throw around like, he's worth 2.1 billion or 2.5 billion. I mean, that's a big difference. It's $400 million you're talking about there. But the difference between 1 million seconds is 11 days, 11 or 12 days. 1 billion seconds is 33 years. And 1 trillion seconds is basically 33,000 years. Like that, and now we're talking twice that. Mm-hmm. It's 10% of our entire economy. The gross national product of this country is, call it 22 trillion.
I was gonna say our GDP was like, it was like
we just decided to print 10% of that. So to me, that's not a good thing. That's a bad thing. And anytime the government has to get involved, there's going to be huge unintended consequences. What pisses me off the most is the airline industry. Over the last 10 years, they spent $45 billion buying back their own stock. Mm-hmm. Now, in history, that's fine. People have done that, but they used 97% of their free cash flow to do it and took on debt to pay for everything else. They asked the government to bail them out for $50 billion. The government actually gave them $58 billion. So basically they invested 45 and the government bought it for 58. So they made money on the deal.
Well,
That's
and that wasn't the stock buyback. It was nixed though. They cannot.
Well, that's for future buybacks.
For future,
Why aren't they saying, okay, airlines, you have to sell all those shares you bought back first at this giant freaking loss. You're going to flood the market and make your stock go down even more before we'll give you a dime. That was never floated. I'm fine with not allowing them to do buybacks in the future. It's dangerous to say that because there's reasons you want to do buybacks. Like look at Procter & Gamble. They fund the most robust retirement plan with their own shares that they've bought back. They give those to their employees. So without the ability to do that, that's going to dramatically change benefits. It's going to dramatically change a lot of things. So you got to be careful when you set knee-jerk regulations. But to me, it's that when the government gets involved, they're picking the winners and the losers, and that's very dangerous. We saw the result of the moves we made in 2008 is banks got bigger, big companies got bigger. It became more difficult to be a small business owner.
Well, I'm so glad that a lot of it is they directly went for the small business on this one. Now, will it be implemented properly? I mean,
no, there's always going to be that fluff and that mismanagement, as governments are always that way. But
are you going to what is it? What is it? What's the $800 billion website? The Obamacare, the healthcare.gov, $800 billion or whatever.
Well, yeah, I don't know anything about that, but so no, really, I like to focus more on the macro picture. Yeah. We have decided we're going to probably have I originally thought it'd be a $4 to $5 trillion budget deficit this year. It's going to be more than that. And if we go into a deep recession, it's probably going to be twice that next year, which means that we go from $22 trillion of debt to 30 in 2 years. That's really scary because now we're talking about major issues of growth in the future, the higher that number gets. And anyone who suggests that it's different this time doesn't understand simple arithmetic. It's so. But we're throwing out numbers that are so incredibly large that $30 trillion. Like we generate $22 trillion as a country top line revenue. Like that's our gross domestic product. And so
when we're operating. When we're
operating at full capacity, that's definitely going to shrink. Going forward, I think we'll get back there. Just like 2008, everyone thought the world was going to end, and had they let the banks fail, it probably would have. But it doesn't mean that life ends, and it doesn't mean we don't figure out how to make a different, better world in the future. It just means there's a lot of pain going forward. I don't think we're there with this. Cases just crossed 1 million globally. It doubled in 6 days globally. That's not a lot relative to the population of the globe. And so we're still going to have a reasonably similar amount of people on the planet after all is said and done. But it's also the reason people are freaking out is because they don't want a loved one to be one of those people that died from this. And that's happening. And it's happening quickly in places like New York. So I just think that the psychological impact of all this is going to be so severe. We're just going to look at life differently. Look at the smog. Have you seen those? Of like pictures of LA or Shanghai
gone down? You mean?
There's no smog.
There's
no pollution. It's gone. Pollution's gone. And that was like in a week that happened.
Isn't it to me that's positive though? That's cool. It's
sure, absolutely, it's great.
It's
but it also means that nobody's working.
So that's the negative of it, right?
Right.
But
so you got to weigh that. And I think that people are going to think about things like that now, and they never really thought to. I think we took a lot of things for granted, and I think the positive thing I'm taking on this, like just me in general, like my wife and I, we both work, we both stay at home, and we got 2 small kids.
Yeah.
So, and our daycare closed. So we're not going to hire a nanny because we're sheltering in place and it's just us. I don't want to bring anyone outside in. And so we're figuring out how to teach our kids and not just stick them in front of the TV and get work done, which means we're not sleeping. We're losing our mind. But the positive of it is we get to see them all day. We get to spend all this time together. It's a high stress environment because we've got all these stresses. But when you're around little kids, and I want to hear about your littlest one, but when you're around little kids, like the perspective change, I think we're going to have all of the perspective changes that we're going to have, I think, are positive for the species. I think we were way too focused on work. We were way too stressed out. We were way too underslept, malnourished, whatever it is. And I think this is giving us a chance to, I think, reset, I think that's a positive thing. I think economically it's a disaster, but we'll figure all that out.
What if so I guess the way I look at it though, what if it's a big ass reset?
Yep.
I mean, what does that money actually mean if it just gets all wiped out, right? Like everyone else is getting hit. So the reason why we send everything to China, right? Because China, we can get it cheap. Sure. Right? The globe is being affected by it. So it's not just us. I mean, it's everyone's kind of being brought down. So pumping more money, I mean, it's a ton. Like that's to put it like Germany, I think has like 2 million in debt or 2 trillion in debt total. Like
it's way more than that. The problem with that is it's got they're part of the Eurozone. So it's hard to calculate how much an individual country has, because especially countries like Germany are financing Greece. They're financing all the smaller companies in the Eurozone. So it's all buried in that minutia, but yeah.
What if what comes out of this is like universal income? I mean, Andrew Yang, huge on that. Like,
I don't have an economic perspective on that. I think that, I could go ahead and pick a lot of holes in that theory. Yeah. I think there are I think we're seeing a lot of the acceleration of the problems that he was talking about. I don't know if that's the solution, but the problem, sure, is automation, and now virtual work is going to monopolize the available jobs going forward. That's where the opportunity is. And if you are in a place where you can't adapt to that, I think it's going to hurt. And the benefits that you need to get through, I don't know what those look like. I don't know what the solution is. But yeah, the world changed. The world has completely changed. And we thought it was going to take 20, 30 years, and we did it in 2 weeks, 3 weeks.
So it's kind of funny because going into looking back, let's say in 2002, when I graduated, I'm thinking 2020, I'm going to be in a flying car, right? And I got to 2020 and I'm like,
we do have them. They're called helicopters, but
this is not what I thought it was going to be. And then all of a sudden we get this, and then it's accelerated. 2022 is going to be different.
Yeah. To me, this is more structurally, from I think, not to pontificate too much, but just this is a more holistic change to the society, where 2008 was that was going to be had we not done that, the backstopping the banks, we would have gone into an economic depression that would have exceeded the Great Depression. Everyone's dollar would have been almost zero. International trade would have been wiped out, and the internet probably would have stopped working. And so there was a necessity to do that, because the numbers there, much like you were saying, it's what was that comment about this forbearance issue is, potentially $10 trillion, and their normal profit of all those companies is $2 trillion or whatever.
Billion. So it's So if it goes 3 months, they lose 70 billion. Whereas for the whole year, last year, their whole profit was 10 billion.
Right.
That's it.
So that was the risk that banks had taken on the entire financial system. and it was all based on the housing market. And if values fell, the value of the loss compounded itself. That's the problem with using leverage. That's not happening here. I think that there's enough money in the system to backstop some short-term disruptions, which is what's happening.
Mm-hmm.
The issue becomes if it turns into a mid-range problem.
So I think where everyone's like positive that are very like it's going to be a snapback is because the banks were the issue, right? It was not
of 08 or now
of 08
sure.
08. So and then the other thing too with 08 was the banks were on the hook for the payback. So the banks paid back that money, right?
Sure.
This coronavirus is not going to pay us back. Like we can't give that tab, right?
Right. Yeah. You can go ahead and try and get it from it, but it's not.
So
it's
so we can't just say, hey, you owe us trillions of dollars. So that's
sure.
I mean that's part of an issue with this as well. But yeah, I don't know, man.
Like I said, I think it's gonna be slow. I think it's gonna be. I'm not making any big bets either way.
I'm put.
Yeah, I just like you were asking. I know you were asking if the market's going to go down. I think there is a strong likelihood that we haven't seen the bottom.
Yeah.
But being short against the market right now, the risk is that a drug comes out that relieves everyone's fears, and the market will rocket back up. But don't get confused with the stock market and the economy. Those are two very different things. The stock market's going to do its thing, and historically it's 6-month leading indicator. So whatever it's doing, the economy will basically be there in 6 months from now. And so we had a dramatic sell-off. So basically that means in September, we're going to probably see that come through in economic data.
Do you think that'll still correlate though? I mean, do you still think that'll be there? Like that lead time, lag time?
I just think that when you have the issue that we have and it being so big, it's like an engine, just stopping an engine. I think about an old crank engine, like just stopping an engine takes work to start it again. And we've destroyed a lot of the infrastructure that our economy relies on, both financially and physically. It's just travel, the movement of goods, that's all just stopped. It's not working right now.
Well,
so to start it again takes a lot of time. It's like, think about Macy's furloughed all their employees. Mm-hmm. Do you think they just unfurlough all their employees?
So I think Macy's is dying anyways.
But that's my point. Like, that's just an example of, or Marriott, same thing. Do you just think they unfurlough everyone? No, they do it slowly. They open regionally. If you just happen to work in a hotel where it's not on a Caribbean island where people have to travel, get on a plane and go to, where it's more stateside, I think you're probably going to open up faster and get your job back. And that hotel is probably going to fill up faster because it's more reliant on business travel. That turns on first. But even the businesses sending their people on planes, I think it's going to be a while. And the people refusing to go is going to happen more and more and more. It's just going to be a while for that.
I think we're not taking into account the amount of lawsuits that's going to come out of this and just the legal ramifications. I
guess we could invest in lawyers. That might work.
Right, maybe. I want to hit
LAW.
But I want to do housing. So housing, everyone's obviously worried. I do think we're gonna lose some equity in our house, right? But how do you lose money in housing? You don't lose unless you sell, right?
Well, yeah. Look, so the thing I like about real estate is the value does not change every second, and I can't pull it up on my screen. When mutual funds were first invented in 1933, they valued once a year. You would get a statement at the end of every year. Here's how much your money's worth, and you had to wait a whole year to get the next statement. And then they went to quarterly, and then they went to monthly, and then computers were invented and we could see it daily. And so if you saw the value of your house fluctuate that much, you would trade it more because we're emotional beings. So
Sure.
You're right. You don't lose any money, just like in the stock market. No one's lost money unless they've sold. It's the value has changed. Yep. But until you realize those losses, you haven't actually lost money. And so, yeah, with housing, it's real easy to sell a stock. It's really hard to trade a house, and so it just moves slower, which is good. And that's why the housing market doesn't generally fluctuate as much as the stock market. So You're right. Housing is good. Where I'm concerned about housing, where I think the hardest hit is going to be the commercial side of things for offices, office commercial, big commercial with malls, like anything, stadiums, anything that houses a lot of people at once. That's going to be the last to recover, if it ever does. Single family homes, there's still people being born. There's still people being graduating from college, getting their first jobs. Not right now, but they will. The risk is small. So selling out, the only reason you should be thinking about selling right now is if you can't afford to service it. So whether you've lost income, if you've lost your job and you can't afford your house and you want to put it on the market just to cut your expenses, you might want to try renting it first. But, there are obviously reasons that you want to sell even in this market because you have to. But if you don't, there's no reason to sell because you think that the values are going to decline over the next 2 or 3 years. And I'm still going to get rent from my renters. If my renters lose their job and they have to go downsize themselves, I'll find new renters. There's always people out there to rent houses. So you should not be selling.
I'm trying to buy more.
Well, I'm trying. So I would love to as well.
I'm always trying to buy more, but
that may be hard because what we started this off with is there are some structural issues in the financing of real estate that need to be worked out.
Yeah.
And that's either going to come through a lot of pain or it's going to come through a lot of stimulus, whatever it is, that all has to be worked out. And until it is, I'll be on a call tomorrow morning with Bonnie. And so I'm really anxious to get Bonnie Overbeck. I'm anxious to get her take on the real estate market, but you're starting to see it like New York's real estate market. They had 2 apartments sell in the last 2 weeks.
Yeah.
In the whole city, 2.
So, like I said, general applications for real estate. This is not me. This is general, credit pools and applications. I think we're down 50%. Showings are down 50%.
How recent is that data?
That's pretty within the week.
Okay.
Yeah.
It's down 50% from a year ago?
No. Just from week over week. When we should be going up right now.
Sure. Yeah, no, it's terrible. It's terrible. And that's just applications. Like for what you and I were talking about, like all those applications that came in, how many of them are actually going to get to close?
Right. Now, whereas your pull-through rate and conversion rate was probably, I don't know, much higher, you're probably knocking 50% of those off or not qualified now. And that's a big issue.
The other ones that qualify, like how many banks are going to either make them too expensive by charging points to make money,
correct,
or they're just not going to be able to afford to finance a mortgage anymore.
So we've
got to work through all that.
We could talk about that as well, because honestly, I think the servicers, the next thing that they're going to do is, hey, we're going back, and this is how it used to be. They used to charge points for you to acquire that loan. So points, for people who don't know, basically equates 1 point is 1%, right? So if
the value of the loan.
Oh yeah. So if it's $100,000 loan, I charge you 1%, $1,000. So that's how the servicers would make the money and be safe. That's what they're doing right now. They're effectively raising the rates back up and charging points like, hey, we know that these are not going to be performing assets, but if you give us $1,000, that takes that off. We're fine with it. We're going to take that risk. Here's the other thing too. Nobody wants to do mortgages right now. Like the banks don't, because if I do it at 4% today, we're thinking that it's going to be lower in the future. again, it takes them 3 years to make that money. So if it's refied out in 6 months, it's not good, right?
Right.
So
For
what
sure.
I'm recommending everyone right now is basically get your appraisals in. If you're thinking about refinancing, you get your appraisal done right now, which is probably going to be, unfortunately, at our top of our market for value.
You're doing a cash out refi. That's great.
Yep. And then in like a month or two, because appraisals are good for 4 months.
Oh, okay.
So, yeah. So you get the appraisal done, you sit on it, rates go back, everything settles back out, rates go back down. So you get the best of both worlds.
What is a 30-year mortgage rate right now for an investment property?
For an
Like-
investment property, so I was in like the 4.5s there for a minute. I can't find par rate on a lot of them right now.
What does that
back
mean?
back up to 5.625.
Whoa.
It just, the investment properties, they pretty much all of them backed out.
Now, what's this part of the stimulus? Do you know much about the landlord? There's a component to it where if you're a landlord,
The
you
no
can-
eviction stuff.
No, you can refinance up to $2 million at.
So the 2 million, that's the SBA stuff. So that's all being pumped through that SBA, and that's what we're trying to get more information on. We had Chris Finney on the other day, and he was excellent. And he's doing, I think actually here in about a half hour, he's doing a webinar that's going to go over it. So the issue is again, they threw this out. Nobody knows how to implement it and what it actually means. So we're still digesting it. But there's two parts of it. It's the payment for Protection Act or whatever for the payroll protection, and then there's basically a loss. So there's two portions of it. It opens up tomorrow. Friday is when they can actually start them. So we'll see.
Yeah.
I think it's a lot.
You want to be early before regulations come down, right?
Yeah. Well, so that's the other thing. So like I was talking to one person that's doing them. Basically, they're like, it was like a no doc thing. They're just like, yeah, just tell us how much you want. And then all of a sudden they're like, actually we need your payroll, we're going to need a little bit more. So the issue is they're up against a time crunch. If they don't get this money out fast enough, then it's not effective, right? That money pumped into the system in 1 year from now doesn't do shit. You know what I mean?
Sure.
If it needs to be out there right away. But with that, you're going to have frivolous stuff, right?
Well, there were 25 airlines started 2 weeks ago.
Right.
And 52 cruise lines.
When there's like 3 airplanes in the sky right now.
Yeah, no, none of these airlines have airplanes. They were just registered as airlines so they could then claim some federal assistance.
Right. So that's part of what I was talking about before was the healthcare.gov. It was $800 billion to make that website, and it ended up being clunky and crappy anyway. So like putting your faith in the government on implementing things is never. Well,
that's just what, like, it's just going to take a while. Like nothing's going to happen quickly. And, there's so much to be seen, so many things unravel, so many things to watch what the consequences of these actions are.
Yeah.
To make an investment decision, whether it's in real estate or it's in the stock market. If you're retired, you should be out. You should be extremely conservative. But if you're still working, if you're in your 40s and your 30s, this is a great time to buy. So you should be just hammering down. And so, from a real estate standpoint, as soon as you can get a loan, you should be looking. I just think that the major downside that I see happening is that we don't get the virus under control. And that
I think I've neglected, I'll be honest with you, I think I've neglected the actual virus itself. In the very beginning, I was looking at infection rates, death rates, like analyzing the numbers. I'm making myself crazy, right? Because that's what I do. I analyze stuff, I run the numbers. And then I think I kind of moved to, this is this is a broad financial thing. And like you said, you've got either the health or you've got the finances. Like, which one do you put as your top priority? I don't know. And will we ever know if we made the right decision? I don't know.
Well, no, I think that My journey, I was a late adopter too. Like I did the same thing. But once I started seeing the stuff out of Italy, where it's not about, to me, it was never about the death rate. It's about the chaos that a lot of people getting infected all at once causes. To where the conservative estimates is if we did nothing, I mean, look at what's happening in New York City, and that's with a quarantine. Mm-hmm. That would have happened broadly. Like just take our country, for example, all at once. Anyone who has a life-threatening ailment outside of COVID-19 would have died because they can't get to the hospitals. So a crippling of our healthcare system compounds the death rate to where it's way higher. So for me, it was at that moment where I'm like, okay, we can't have that, because that I think scares everyone way too much. Mm-hmm. The consequence of doing what we're doing is we've just delayed I think the other side of this. You know, the solution to this is that COVID-19 is gone. And I think it's going to take a vaccine, which is 12 to 18 months away, before it's actually really gone. Because for all I know, unless I'm an asymptomatic carrier, I haven't gotten it yet. My family hasn't gotten it yet. We've been in our house. Mm-hmm. And so we still can get it. And so when we all go back to work, there's going to be people that get it from all the people that didn't quarantine. I mean, Georgia did it yesterday.
Yeah. Like West Virginia was like the last one to hold out on not getting anything.
Right. And so like you look at all those things, and you look at like New Orleans, what's happening there. They were late adopters. Anyone who was a late adopter. And I mean, DeWine there in Ohio, like he's now getting chastised from all the economics of it because he just was a very early adopter. Yeah. Well, you don't have a problem because he was an early adopter. And I think we can figure out the economics of it. We cannot figure out when someone's dead. And to me, that's I quickly fell on the side of we're making the right decision for the species. Yeah. But what I was frustrated with was the lack of a plan nationally. That bothered me a lot. And I think a lot of lives are going to be lost because of that inaction or decisive leadership that I think we needed. And our dynamic, anyone that quotes another country comparatively, we're a very unique country in this world. You know, we have a federal government, we have state governments, we have local governments, and a lot of them have authority where other ones don't. And so, yeah, classic. I love it. That's the perfect sign. That's the perfect sign of our new economy.
I mean, it's
people are so beyond that mattering that's one of the positives I see about, you know, kids in the background. Yeah. Or you're wearing a sweatshirt, you know, it's like I've got sweatpants on, you know, underneath this under this nice shirt.
Right.
We don't need to have any pretense anymore. Like that I hope is a positive. But anyway,
going to real estate though, do you think people are going to spread out into like, hey, maybe not downtown anymore, but like spread out because they can telecommute?
Are you making any decisions based on SARS?
What do you mean?
Like, this is not the first iteration of this virus. You know, this is the second. And, you know, it didn't have the same global impact that this is having, obviously. I was having a conversation with my wife last night about this, about how long was it after the terrorist attacks of 9/11 did we come back to a normal life? Outside of TSA, was it a month? We all just said, you know, I mean, we had a war that started pretty fast after that, but for the most part, we moved back to normal life pretty fast. I think we do that here pretty fast.
As soon as we can, like, we basically have a boat with a hole in it right now, right?
The virus there has to be a global confidence that we aren't going to have another spike in the virus.
Yeah.
What that takes, I have no idea. I'm not a health expert, but I just see that there's
Flintstones.
Huh?
Flintstone vitamins. That's
Oh yeah,
that's all
yeah.
you do.
I'm surprised you can still buy
All
those.
you do.
You
I'm
can't
gonna
buy
get
toilet paper, but you can buy vitamins.
but
So no, I think that I think we do hit a pretty bad recession. I think normal unemployment, the numbers we're seeing are not normal because they include furloughs. I think a lot of those come off in a relatively fast pace. But I do see us hitting like a 10% unemployment number that's real.
that's real.
I think we see a dramatic spike of 25%. I would just love to see, us breaking that 24.9% record that the Great Depression happened, knowing that it's going to come down
Come
pretty
back.
fast.
Yeah.
Because furloughed people will come back to work, but not all of them.
I think we'll hit. I think it'll be 30. I think we'll hit 30.
Yeah, if we're all able to go back to the office on May 1st,
Yeah.
I don't think we see 30.
Yeah.
I don't think we have major foreclosure issues. But I also
I don't think either.
I don't think we go back to work on May 1st.
Yeah.
I think that when you have peaks happening in various states, I think some states might, Ohio might, but I think when you have peaks in various states, to me, what I don't understand yet is the timeline of when it will be okay culturally, socially, and legally to actually go back to a park,
Mm-hmm.
and like whether even when they open it up, yeah, a large percentage of the population is going to flood a park. But me personally, I'm a little nervous. I had asthma as a kid. I don't know if that's going to affect my ability to be able to recover from this job or from this virus if I get it. So the fact that it's still out there and it will still be out there for a long time, I think gives enough percentage of the population pause to shrink our economy enough where it's going to affect us into a recession. That's going to be maybe a 2 or 3 year recession.
And I think you were, even January, well, very early in it, you're like, hey, is this recession or depression?
Because when you're talking about shutdowns, there's no precedent there. We never had a shutdown. We were joking about this before. A buddy of mine were trying to go back. He's a colleague, and we were trying to go back in history of, is there any precedent here of a country just turning itself off economically? And the only one we could come up with was when the Roman Empire would rape and pillage a village. You look at the economic impact of that in that village. That's what we've done, minus the raping and pillaging. We've just turned it off. And so to turn it back on, there's going to be it's like killing the power in your house. There's going to be some things that come back on normally, and there's going to be some things you got to create some workarounds.
Yeah.
So I'm not buying the fact that we're coming back quickly. So I would just be very cautious.
I think as long as people plan, right? And first off, don't freak out. Don't go selling off real estate.
Oh, absolutely.
I think if you look in 2 years from now, your real estate value is going to be greater than it is now. So why would you go selling off? Because you're going to save. You have cost on it. Unless you want another house, then that's fine. Go buy and sell houses, right?
Sure.
Because if you buy, say we're here, and even if it goes to here, you exit here and you enter back in here.
Right.
Unless you find somewhere to go live for a while, which I'm going to go ahead and tell you my plan right now. This house right here is going to go on the market. I'm going to downsize temporarily into a home that I will end up 1 year later. It's a rental, and I might bury it, and then I'll go back into a $400,000 or $500,000 house, because I think that those are going to get hit a little bit harder. So, but my barrier entry is different. So I'm going to upgrade, right? Because I know in 2 to 3 years, then it's going to be even more. And plus, I'm gonna take my money and buy about 5 more houses in the meantime.
So now that's a sound investment strategy. I just think that, you never want to make an emotional decision, especially when it comes to real estate, unless, like I come back to, unless you can't afford it, unless unless you've lost your job or you're furloughed and you're just not going to be able to make that mortgage payment. Go into the forbearance if you are attached to a house, or if you have to. don't try to take advantage of a system because there's nothing there to take advantage of.
There's no gain. There's
right.
no financial gain to it. And I think that's what needs to be spread. The news is just not doing that.
Well, but that's when have they ever done that, right? Like, come on.
Yeah.
You should also never make financial decisions based on what you see on the news.
Yes. Yeah.
You know, especially like stocks. You look at, there was a guy who did a fund. It was a fake fund, but he tracked what Jim Cramer recommended on Mad Money, and there has never been a year it's made money, and over a 10-year period, he's down like 80%. It was like, yeah, it's just, they are great entertainers, you know.
I like watching them. I mean, but
yeah, I mean, I can yell at the screen too, and it's really entertaining. But yeah. So I don't know. I think that, yeah, you definitely should not be selling real estate unless you have to.
I don't think so. I don't think it matters. I think if you sell and buy, you're completely fine.
My point is that if you lost your job, you can't buy. Like, you
Correct.
have to. If you have to, my point is that I think there's going to be a lot more of those than you are expecting. You know, real estate is slow. I mean, real estate didn't bottom until 2010 or 11.
10, yeah.
I mean, the market was back after that. Like, the economy was back. You know, banking is slow. I mean, shit, banking still, you have to do wet signatures.
Yeah.
Like, come on.
So that's the other thing. Like, they implement things up here, but it doesn't mean, just because it's allowed up here federally or whatever, does not mean that it's allowed at our local status. And that's where, like, the e-notary, it's great. I'm working with title company. We're trying to figure it out. Like, we are rushing to figure it out. But it's just like how the federal came out with the CARES Act. Hey, now the forbearance stuff, that's fine, but the servicers have to do it. So, like, they just threw it out and pushed it on people, and it's got to be implemented, and it's there's no direction behind it, which is the scary part.
Yeah. So, like I said, I think unless you're in that group that is directly affected by all this, you should not be thinking about selling real estate. You know, like me, I have a few rental houses. I'm not thinking about selling them. That's silly. I don't need the cash right now. But if both my wife and I lost our job,
then you do what you got to do. Yeah.
And if my tenants all lost their job and I couldn't rent the place, now I've got an issue. Now I've got all these mortgages I got to pay for and no renters. That's a whole different situation.
Yeah.
But that's not the situation for, I think, a lot of people. But if we have an actual unemployment rate going up to 10%, that only is triggered, and that's only realized in the housing market a year or two later.
Yeah.
So I think we don't see the effect in prices happen for a couple years of what's happening now.
What about the CARES Act removing the penalty for 401k withdrawals and stuff like that? What do you think that's going to do?
Well, now you're allowing people to make dumber decisions. Like, what is that? Yeah. So great. That helps those that need it. Sure. You should tap it last. You should, I mean, what was it that 60% of Americans have $1,000
or less?
In their, something like they can't afford $1,000 emergency. So yeah, I mean, if that's the only cash you have to pay your bills and you're confident that you'll do it for a couple months to get you through until you find a new job, fine. And that's the right thing to do. But to open it up globally, people are really bad at saving money, and when they have money, they're really good at spending it.
Yeah. So
I think you see that's another example of maybe you see dramatic selling continue because everyone's liquidating their 401k because they can. I mean, I've got IRAs and 401ks from old employers that maybe I take advantage of that and pull it out of the market and buy some real estate.
I was to say, right into real estate. I mean, but you're making a good decision on it, but how many they're not. They're going to
go buy TVs. They're going to go buy a car. They're going to go buy clothes.
Tigers.
They're going to go buy
Tigers.
Well, apparently those aren't as expensive as I thought they were.
I'm pissed that I just found this out Because I totally would have had a Tiger a long time ago. 2 grand, that's it.
For sure, for sure.
Yeah.
So anyway,
But I think that getting rid of that penalty, again, it sounds great, and it's one of those things that are meant to help, and really does help some people. But it's
now if they got rid of the having to claim it all as income on your taxes, I could see that being a positive. It would be terrible for the stock market. Like if you
see it being positive overall
for the real estate market, like I would liquidate a lot of mine. I would liquidate some clients' accounts and say, hey, you should pull some money out of your IRA now. Or you just liquidate all your IRAs and move it to taxable. It becomes a lot, for a lot of people, that makes a lot of sense.
Yeah.
Having money in IRAs, especially like baby boomers, all their money is in IRAs. And so if you're able to pull it out and just put it in taxable account, it's way more tax efficient to do that than, having to claim every withdrawal as income. But they're not going to do that.
Do you think this changes the stock market too, and changes valuation? No, you think it goes right back?
No, because nothing. 2008 had a better chance of doing that.
Okay.
Like 2008 was an area. I mean, did you read the book or see the movie The Big Short?
Yeah.
Or Too Big to Fail on HBO? Yeah. So Too Big to Fail, I think, was a really good example of how close we were to ruin. I mean, it was literally, I was working at Merrill Lynch at the time. It was literally days away from all the big banks just closing their doors, and whatever money was left in ATMs was the only cash out there. Yep. Days away from that. So that would have, I think, altered the way we financially interact with one another. Where this, I don't really know how to interpret this just yet.
So and I guess that's where, and I know some people are like, man, you're freaking out about it, but like the liquidity issue is real.
Well, I think for your segment it is, but yes. I think broadly it's not.
I agree with that.
What I would like to really know, and no one knows this yet, is why banks had liquidity issues starting in September of last year. So the repo market. Do you know what the repo market is?
So I just looked it up a little bit ago. Explain it. No.
All right. So when you have, let's say you've got
repository,
a hedge fund. So there's about $2 trillion a day that goes back and forth between the counterparties of the repo market. So let's just say you've got Wells Fargo. I don't know why that came first to my mind because they're pieces of garbage, but Wells Fargo and a hedge fund, Axe Capital, if you watch Billions on HBO or Showtime. So Axe Capital might have a lot of treasury bonds on their books, and they might be wanting to do maybe a hostile takeover or whatever, and they need a lot of cash to invest. A bank, Wells Fargo, might have a ton of cash on the books. And so they swap, and they make an agreement that in a day or two, they're going to swap back, and they're going to price that transaction where the purchaser will buy it at par, and then the seller will buy it back for a little bit more. And that incremental change is effectively an interest rate. And so if you swap $1 billion, and then to get it back, you have to charge $1 billion, $1.1 billion, that's a 10% in exchange rate. So, and that all works really, really well. And like I said, $1 to $2 trillion trades hands that way every day. So companies sometimes use it to make payroll. Sometimes companies use it to, when they just have a cash shortfall for whatever reason, for a temporary basis. That all happens on the New York Stock Exchange or in and about that area. Well, in September of last year, there was a breakdown in the supply of dollars to the demand for those dollars. And so the interest rate, which is called the overnight interest rate, went up to 10% in one day from essentially 1. So it went up 10 times. And the Fed came in and said, we're going to backstop this. We're going to provide $50 billion of liquidity because that's the shortfall of that day. Mm-hmm. And it was right around, it was the middle of September. And so people were starting to make tax payments. And the news that was reported was companies and banks didn't have enough cash to make their quarterly tax payment. That's horseshit. There was something else going on. I've yet to be able to really fully understand what it was, but the repo market had structural problems almost every day since, and that was September of last year. And so those problems were only more compounded when you had this all happen. And so there is a liquidity issue somewhere. I just don't know where it is. I think it has more to do with stock buybacks, companies using more and more of their cash to buy their own shares, and then they borrowed money to buy their own shares. I just think that you had a lot of those dynamics where some people did it too much and got in trouble. Some people, for whatever reason, there was a pretty significant, a daily shortfall of $30 to $40 billion.
So where does it go to? Where's the VIG? Where is it going to?
What do you mean?
Like who? So it's just, if I'm on the cash side, I'm getting that
You're a
interest
bank.
essentially.
You just want to earn interest on your cash that you've got too much of.
Okay.
And so you're going to loan it out to someone who needs cash for a short period of time. And so the VIG is, if you got $1 million in cash, you send it, like if you're bank A and I'm bank B, you send me $1 million. Tomorrow, I'm going to give you back, $1,100,000, $1,010,000, whatever. And so we negotiate that. And that's negotiated every day, every second of every day. And so that'll fluctuate just based on supply and demand. There's a whole market. It's not traded on the New York Stock Exchange, but there's a whole market for that. That big companies, big banks, big financial institutions, hedge funds uses all the time to close deals, to do whatever. There's just tons of transactions happening every day.
So
And
I think what
fails, it's like no one really knew what the repo market was because it never has failed before. Even in 2008, it didn't fail. And now it's failing, and it was failing in September of last year, which is really strange. So
did the feds come in and pump it, or
30 to $40 billion every day? They have to backstop it. Now, whether or not it's actually used, it's really more of there are spikes in demand, and the supply in that moment couldn't meet the demand, so you had the rates go up. And so they just said, we're going to be here to cover any of those spikes that happen, just because the supply was just not there.
So where the rates don't go to the 10%, they keep it at the 1. The feds pump in 40 billion, whatever, but it comes back. Yeah.
Oh yeah. No, it's not. The Fed isn't just printing $40 billion every day.
Yeah.
It comes back to them with interest.
Yeah.
Sometimes, but a lot of those loans though were at 0%. The Fed didn't get any interest for it. So yeah, that was the issue in September of last year. So I've been arguing for quite some time that we are overdue for something major. I did not expect it to be a virus that would get us here, but there was always going to be a straw that breaks the camel's back, and I think it was this. So to think it was anything less is, I think, a little foolhardy.
Do you think, and that brings my point of, hey, some of the companies that had maybe some losses, it's all going on the books right now. Like it's all, whether it was actually related to coronavirus.
You got to bring those losses forward. It's in your best interest to call it coronavirus. Oh,
exactly.
Sure. Yeah, I got my degree in accounting. I mean, there's the thing that I laughed about. One of the reasons that attracted me to accounting is there's nothing black and white in that industry. The whole entire industry is based on what's called GAAP, and that is generally accepted accounting principles. What's finite about that? Like, it's no black and white. Come on. So yeah, when you have things like Arthur Andersen bringing down Enron and all that stuff, well, yeah, that's what that is. Generally accepted
practice.
Not specifically accepted, just generally accepted. So yeah, that is going to be used. There's going to be tons of loopholes exploited. Yeah, the corporate earnings that are coming out this next quarter are going to be pretty bad, but they're also not going to be as bad as the second quarter because we had the first half of the quarter was business as usual. Yeah. And so it
booming. For most.
Yeah, it'll probably be a flat quarter. It might be negative a little.
Yeah.
Like the GDP number, if it's not negative, I'll be surprised. But the GDP number won't be -10. That'll happen in second quarter, though.
Like 3 and probably.
Yeah, because you got April, May, and June, and
Yeah.
unless June is back to business as usual, we're posting a terrible quarter. So
Yeah.
all of that data, when it comes out, should be a negative on the stock market, only because people are still expecting there to be a snapback rally economically. I just don't see it happening.
What are you looking at? So what indicators do you look at? I mean, you can't, to me, unemployment is, yes, it's a number there, but it's not like we used to follow, right? With the jobless claims, like what do you follow now? What indicators?
Well, so I'm pulling them up. We've got the ones that I like most. So the PMI is a really good, PMI is the manufacturing index. That's a really good one. The jobless claims, factory orders is a good one. Unemployment, average hourly earnings is going to be a really good one. Let's see. So the thing that I'm really watching though is inflation.
Inflation.
That's the one that, with gold running right now, the part of the stimulus that's good is that money's going into individuals' hands.
Yeah.
And the part of the stimulation that's bad is that money's going into individual hands. That's immediately inflationary. And if you give people the money they're talking about giving, and those people return to work in 30 days, that was just a gift.
Yeah.
And they're going to spend that frivolously, which is great economically, but it's also very inflationary. And so when you're talking about, I think it's $500 billion of that stimulus package goes right to people. That's a big number. And so
which, I mean, you divided it out. It's what the debt that we're adding onto it would be about $6,000 per person. Is that, I think I did the numbers on that. Like the $2 trillion would equate out to about $6,000 per person. So that's debt added on the back.
But here's the problem: is it's not a lot of the debt. A lot of that $2 trillion is going to be issued through the financing of long-term government bonds, and so it's not going to be short-term paper. It's not going to be where inflation isn't going to affect it as much. But there's only so much of that you can finance with. I mean, no one's going to go buy a 30-year government bond at 1%.
Yeah.
That's a stupid investment. And now they're talking about, with the infrastructure bill, issuing a 50-year bond. Why would anybody buy that? Like, it makes no sense. Some people will. I don't think they're going to be able to. They're talking about $6 trillion infrastructure bond or a $6 trillion infrastructure bill. They're not going to be able to sell $6 trillion to anyone. And so then they'll have to finance it short term, and now you're subject to interest rates killing you. So what's really worrisome about all this is inflation. So you watch consumer prices, you watch producer prices. So the PPI and the CPI are indexes that are really, really important over the coming years. But really the auto numbers, they actually decided not to release those. Oh no, motor vehicles. So they just came out with those. It was 3 days late, but the motor vehicle sales were reported as 11.4 million, essentially matching expectations for is that a quarterly or is that that's got to be the seasonally adjusted annual average, kind of what we're on pace to sell.
Yeah. With the manufacturer shut down.
Right. So like I said, it's lagging. It should be zero.
Yes.
Like, I mean, or like 7 cars were sold in the last month. Like
producing masks and respirators. Right.
No, factory orders are predicted to be 0, which is cool. Like that's actually a functional number. So anyway, those are the things that I like to just look at. It's really more of when you see manufacturing contracting as fast as it has, don't follow consumer confidence. That's a horseshit indicator. Case-Shiller is really good for housing. Yeah. I mean, it's only the top, 10 markets, but 20 markets, but it's a good barometer. Anyway, there's way too much information out there to digest.
It's just different now because the ones that we looked at,
they don't have the same meaning.
No.
No, because we all know what's really fascinating about this is we all know that the economy is zero minus groceries and whatever Amazon can bring to our house.
Mm-hmm.
I filled up with gas 2 weeks ago and haven't even driven my car except to go to the grocery store for basic needs.
Yeah.
And I have a 35-gallon tank. I'm not filling up for a year at this pace. So like people aren't buying gas. People aren't, they're not going to movies. They're not going to restaurants. They're not going, that's all a zero.
Yeah.
And it's still saying we're growing. That will be reflected later. But yeah, this data is so different now. And I think people will really start to understand what the data means and how it all interacts. But yeah, time will tell. I mean, we should do another one of these in a month and see where we're at.
And it's probably going to be completely different. We're going to have all these different outlooks and yeah. But it's going to be cool in a month because we'll actually be able to, some of the effects will be coming out, right? Some of the, hopefully the moving parts.
Sure.
Hopefully I'm not worried about so the other thing is margin calls. I could have margin calls. You'll start hearing that on. So basically when they, oh man, there we go. There's the new norm. Hey, how you doing? So yep. I hope that this is one positive thing. I hope people will start realizing like, hey, we're all normal families here. Like
for sure.
Getting out of that office thing, that is one cool part that I hope. Uh-oh.
That's allergies. She doesn't have
the Rona.
We're good. Might have to quarantine you.
That's the other thing too. Yeah, you just get that seasonal change. Everyone's like, "What was that?"
Yeah. Well, let's wrap this up.
Yep.
Yeah. Thanks for doing this.
Yeah.
And I hope I'm wrong. I'm just being cautious. I think being cautious economically makes the most sense until we know more.
Well, and that's the thing. I don't see a big upside right now on a lot of stuff. So like,
for sure.
Hey, let's just kind of chill for a little bit, take a pause, and then, unlike me, I mean, I'm gonna be buying. Like I'm stacking and ready, but it's gonna benefit some, and it's gonna really hurt some. And the more you know, the better you can navigate through, and come out ahead. So,
great.
All right, man, it's been fun. We'll talk to you here.
Okay, man. See ya.
All right, brother. See ya.